Welcome to Taking Stock for this week's Thursday edition on the 12th of August 2021, where Jacob Simonsen, our Equities Analyst, and myself, Kien, Trinh, stream to you all things share market. So with the reporting season now in its second week, let's take a look at some of the key themes that have emerged so far. There's been a lack of outlook guidance. With statewide lockdowns in place to combat the Delta COVID variant, business confidence has fallen sharply. And as a result, many companies, especially the domestic cyclicals, have been unable to provide guidance. For example, stocks like GUD Holdings, Nick Scali, REA Group as well. And another theme is that companies with international exposures are faring better. Star stocks like ResMed, for instance, BlueScope Steel, James Hardie, they've released better than expected updates as well. Also, there's been increasing cost pressures. Star stocks that have been alluding to rising freight costs, wage costs, and inflationary input price pressures include your retailers like Nick Scali, GUD Holdings, and also James Hardie as well. And this active risk will continue to impact the stocks in retail, supermarkets, and construction segments as well, although the rise in top line revenue has mitigated the contraction of net profit margins. And finally, you've got the share buybacks and also the special dividends. The buybacks and special dividends have been prominent in the banks and insurance space on the back of surplus capital from recent asset sales and also the release of bad debt provisions as the economy recovers as well.
Yeah, and another active risk that has emerged during the reporting season, Kien, has been the weakening iron ore price as China restricts its steel mill production in reaction to environmental concerns. The country has also been battling with COVID Delta variant outbreak, and this has prompted a number of downgrades to its economic growth expectations. You can see this on screen with the decline in China's manufacturing PMI index. We're carefully monitoring star stocks, Rio Tinto, BHP, Fortescue Metals, and Mount Gibson, because there is a high risk of further selling pressure on these stocks once they have gone ex-dividend.
Yes, that's right, Jake. Monitoring these active risks is so important, especially for these non-traditional income stocks where they're tied to commodity prices, which can be quite volatile. But here at Lincoln, we believe innovation is key to the success of our business and members. Over the last 2 years, we've invested significantly in this quantitative backtesting and optimization environment, and we are now proud to be able to showcase the results. Over the next few weeks, we will be transitioning our Star Growth stock portfolio towards this optimized model, which has shown to generate superior risk-adjusted returns and also help us perform better during the factor rotation towards cyclical value in the last financial year. And in doing so, we hope our members will become even more successful investors. Our Star Growth stock portfolio is based on a high conviction, quantitative driven strategy that ranks stocks on quality and growth factors. And it's based on this Z score, similar to the standardization approach we use for our financial health model.
Yeah, previously we used a screening process to select our stocks, and this has often led to a large number of stocks within our Star Growth stock recommendation list. As we transition, there may be higher stock turnover than usual, especially at the end of reporting season. Though if you do have any questions on building your portfolio from our Star Growth stock list towards the end of reporting season, please don't hesitate to contact our team or your client relationship manager to take you through the process.
Yeah, and we look forward to rolling out this enhanced quant strategy over the next few weeks. But in the meantime, let's now turn our attention to some of our star stock updates over the week, Jake. James Hardie, now they are a manufacturer of fibre cement and building products. The company announced a 5% upgrade to its financial year 22 earnings guidance as the pandemic prompted homeowners to reallocate their travel spending towards renovations, particularly in the US, where the renovations market is growing at around 15%. Moreover, you also have the government incentives, including the home builder grants as well. And as a result, James Hardie is expected to generate earnings growth of over 40% this year, although some of this is attributed to the currency movements, with the company also having exposure to the US, New Zealand, and Germany as well.
Yeah, and the company's experienced cost inflation in the form of higher input costs, such as pulp and elevated freight costs. In addition, skilled labor was inhibiting their ability to grow faster. However, margins were still able to grow, afforded by James Hardie's ability to pass on product price increases to customers and the higher operating leverage from fixed costs.
Okay, and moving now towards star income stocks. Commonwealth Bank, they reported a 20% rise in cash earnings, and that was underpinned by strong lending volumes and also lower bad debt charges. With a strong capital position, the bank announced a bigger than expected market share buyback of up to 6 billion following asset divestments and putting aside surplus funds for the pandemic. Now, the buyback represents around 3.8% of its market capitalisation. And in the words of CEO Matt Coman, the buyback is the most efficient way to return surplus capital, which will benefit shareholders through a lower share count and will boost future return on equity and dividends per share to investors. And those who want to understand the role of buybacks can refer to our question of the week from our previous Taking Stock video.
Yeah, and the final dividend of $2 was slightly above market expectations of $1.90 and represents a gross yield of around 4.5%. We believe the current statewide lockdown should have little impact to future dividend payments because of the bank's surplus capital position, with its common equity tier 1 ratio at 13.1%, and that's well above the regulator's requirement of 10.5%. In addition, its forward payout ratio remains below 80% and in line with historical averages, and this should help it absorb its expectations for an economic contraction the September quarter, with the bank expecting the December quarter to rebound strongly.
Also, Jake, an interesting statistic is that there were only around 6,800 loans on repayment pauses at the end of July, and that compares to last year's peak of 158,000 loans. So, note also that the stock is expected to go ex-dividend next week on the 17th of August as well.
Yeah, meanwhile, National Australia Bank also revealed its quarterly update, reporting a 10.3% rise in cash earnings, and that was driven by rising home loans and lower bad debt in business lending. The bank remains financially strong with its common equity tier 1 ratio at 12.6%, and NAB is also conducting a share buyback following the divestment of MLC Wealth and raising 4.25 billion at the height of COVID last year. The bank's currently trading on a forward gross dividend yield of 6.3%.
Okay, now moving away from the banks towards another income stock that has recovered over the year is Telstra, which has been able to maintain its final dividend at 8 cents per share, which also includes that 3 cent per share dividend. This brings the full year dividend to 16 cents per share and translates to a gross dividend yield of around 6%. The company is also expected to go ex-dividend on the August the 26th.
Yeah, despite this, we believe the dividend is sustainable with the company awash with cash from MBM payments and proceeds it has received from the 49% sale of its mobile towers. In fact, it has so much cash that it's launched a 1.35 billion on-market share buyback. Earnings growth is expected to return on the back of its T2 strategy and 5G rollout and support an elevated payout ratio.
And on the income theme, Jake, during the week, we had some property trusts reporting, and they include the childcare and healthcare REITs, Arena and Charter Hall Social Infrastructure, and a diversified property trust, Charter Hall Longwell REIT. Currently, Charter Hall Longwell REIT is on the most attractive dividend yield of over 6% compared to the other childcare REITs, which have a gross dividend yields at around 4 to 4.5%. But please refer to our analyst commentary for further details on these REITs.
In our corporate calendar next week, reporting season is kicking into high gear with 24 of our star stocks reporting. Please refer to the corporate calendar for more information. Moving to technical alerts, for those who are trend sensitive, the star stocks that triggered a bullish signal in the SD Max include AusNet, Fisher & Paykel, and APA Group. In contrast, BW Trust and Codan both turned bearish on the SD Max. Meanwhile, no changes were observed on the SD30 TSR.
This week, we cast our lens on general insurer Suncorp, whose brands include AAMI and GIO. On an annualized basis, earnings grew by 64%, while their net profits rose to 11.9% from 8.2%. This was driven by increases in premiums, high investment returns, and the release of provisions for longer-term potential claims and bad debts. But the most positive aspect of the result was the 8 cent special dividend on top of the 40 cent regular dividend, with the company planning to buy back 250 million of shares from the market. The dividend was ahead of market expectations at 61 cents and implies a gross dividend yield above 7%. The company is expected to go ex-dividend on the 13th of August.
Yeah, and looking forward, the market anticipates earning growth to fall in double digits due to the wind down of credit loss provisions, higher reinsurance costs, and normalization in claim rates. In addition, there has been a decline in customer policy numbers, and as a result, we've had to remove the stock from our borderline star growth stock universe.
However, Jake, we believe dividend expectations are achievable, with the forward payout ratio expected to be at the top end of its 60 to 80% target range. Prior to executing the buyback, the company currently has 637 million capital buffers above the board's targeted capital level and well above regulatory requirements.
Yeah, that's right, Kien. And interestingly, over the week, Star Income Stock Insurance Australia Group, or IAG, also released its result, which was marred by one-off costs, including business interruption claims. One of the operational risks we previously highlighted has emerged over the period, with IAG taking a 437 million provision for Greensill. Management remains adamant that the company has no net exposure to the now collapsed factoring company. The combination of revised earnings guidance and recognition of provisions could ultimately impact the company's ability to grow its dividend, which is currently sitting around 4%.
With reporting season in full swing and information flowing from all directions, a helpful question this week is, how can investors use Stock Doctor to keep track of their investment ideas? Well, Lincoln's My Journal is an underutilized tool, but a powerful one if used appropriately. An investment journal is a great way to store the reasons for your investment decisions so you can learn and improve from your past experiences. In addition, it allows you to develop your investment strategy and keeps abreast of all important company updates as well. It's also easier to remember things when you write them down instead of relying on reading all the time. As you discover companies of interest, add them to your watch list and include a journal note about why you are watching them. For example, you might have read an article on a company that you found useful. You can also link this article within the journal entry.
Yeah, and accessing this tool is very easy, Kien. Navigate to Tools and select My Journal. Here you can create a new entry and write down your notes on any particular company. You can then tag your notes to a company or companies or portfolio, or even use a custom tag. An example of a custom tag might be a group of gold stocks. On the left-hand side lies the journal filter, which allows you to quickly find your notes based on your tags, dates, or keywords. You can also filter by company name and sort your entries in date order. Keep your journal up to date with any investments or change to your watch list so you can keep track of why you bought or sold an investment. And of course, feel free to contact your client relationship manager if you have any questions about using this tool.
Thanks, Jake. That's all we have time for. I know you're pretty busy during this reporting season, but appreciate, and I'm sure our clients appreciate you being here today.
Thanks, Kien, for having me on.
So the key themes to draw from this reporting season includes the lack of earnings guidance, increasing cost pressures, share price buybacks and special dividends. Also, companies with higher international exposure are performing better. Now, use these themes to reevaluate your portfolio and take advantage of star stock opportunities as our team transitions towards an enhanced quantitative strategy for star growth stocks. At Lincoln, we believe constant innovation is key to your investing success. Take care and have a happy, healthy, and prosperous week, everyone.